Hello everyone. Recently I came across Morgan Stanley India's managing director Mr. Rhythm Desai's interview. In that he mentioned lot of important macro points, why he thinks Indian equities are so attractive and why he thinks this will be the start of boom cycle which India experienced between 2004 to 2008. In addition, he also mentioned about some possible challenges. So, in this video, those important macro points which he described. In addition, I did some back check to those stats. All together combining, I'm going to discuss that as a three important takeaway which we need to keep monitoring so we can get benefited in our equity investment. I hope it will be very interesting, very much statistical and very educational. So, without delay, let's get started. First point, at present, Indian household savings balance sheet is roughly around 700 billion US dollars, which is roughly 18.5% of the GDP. And every year it expects to increase around 10%, which is feasible as it is very close to India's minimum nominal GDP growth rate. I mean, 700 billion US dollars is roughly 58 to 60 lakh crore rupees. Now, if required, please pause and have a look. As per CRISIL rating, in those household saving, near 35% were in the fixed deposit. And if you look at the pre-2020 period, that was near 45%. So, Indian household fixed deposits reduced by 10% compared to pre-2020 period. Then if you see where all those money are going means, it's all going into four sections: pension funds, small savings, equities and mutual funds. Here mutual fund is the indirect of equities. So altogether Indian household savings directly into equities before 2020 it was around 5%. Now it increased to 7% and with pension funds in equity investment the percentage increased near to 10%. Hence, it's clear from fixed deposit, funds are moving into the equities, which is good. But it's not much if we compare globally. We are nowhere near the developed countries. For example, Japan is the lowest among the developed countries. 12% of household savings are invested in equities. Whereas in Europe, more than 50% of household savings are in stocks, while in US it is around 40%. So, India by comparison has much less household investment in equities, which he suggests has the significant potential for the further growth. I mean, part of the reason why developed countries has so much in equities because there is no restriction of pension fund investment in equities. Whereas in India, only 15% of the Provident Fund is allowed to invest in stocks and that too allowed by Modi government in 2015. So with India's growing population and for future, in order to give the better returns to the pension people, at some point Modi government has to allow more Provident Fund into equities, which Desai expects to happen in 1 or 2 years. Again, this also will help the Indian equities to grow further. Bit of section recap. Indian households are moving their savings from deposit to equities, which we already know before. Since 2 years ago, monthly SIP value was just 8,000 crore rupees, whereas today it is over 20,000 crore rupees, and each month passing it keeps on increasing. I mean, every month Indian mutual funds are getting near 2.5 billion US dollars, which they don't have other option. Part of the money they have to invest in Indian equities. So that itself a positive. If government allowed more provident fund into the equities in line with the developed countries means, then that will be super positive. Then the second point is about the pristine condition of India's corporate primary balance sheet. I mean, I can't able to fact check this, but this is what Rhythm Desai said. At present, India's corporate primary balance sheet is around 50%, which is really very strong, healthy condition. Primary balance sheet positive means how much money any company makes after paying the interest for their borrowings. Internationally, this is roughly only 20%, whereas for Indian companies, as per his statement, are making at least 50% more than what they have to pay as an interest. Which means ideally Indian corporates can able to borrow more and can able to increase their business capacity. So he believes in the next 15 to 20 days, all the companies are going to release their capital expenditure incremental plan. As a result, again, that will accelerate the India's GDP growth. I mean, here only he compared the 2004 to 2008 period. In 2004 in India, corporate capital expenditure was 4% of GDP. By 2010, that value increased to 17% of GDP. Hence, because of this capex during 2004 to 2008, Nifty earnings grew by about 30% annually. And in FY 2024, India's corporate capex was roughly 5% of GDP, which Desai believes in the next 3-4 years that capex will increase to 10% of GDP, which in turn probably will increase the Nifty's earnings growth as well. Then the third point, being a Morgan Stanley's MD, he talked about the emerging index fund. I mean, as per their emerging market funds framework, India has a 17% weightage in the emerging market index. But currently, emerging market index funds are holding only about 16 to 16.5%, which is less than their required framework. So, to go from an underweight position to an overweight position, the index fund need to increase their investment in India by 100 basis points or 1%. Desai estimates that to achieve this 1% increase, they would need to invest an additional 50 billion US dollars in India. But the problem is, historically, the maximum amount of money foreign institutional investors have invested in India in a single year was 35 billion US dollars. So FIIs are kind of struggling to invest, and because India is one of the best performing market, being underweight means investors are not benefiting as much as they could and affecting their overall performance kind of. Hence, Desai expects FII will start to buy within the next 6 months. So, these are the 3 important points Rhythm Desai mentioned why he is so positive in India. In addition, he mentioned following 3 challenges. First, at present, Nifty is trading at around 21 multiples and only 2 market index in the world are trading at this higher multiples, one US and another India, which FII cannot able to digest this at all, and that is also the reason why emerging fund index is invested only around 16.5% instead of the above required 17%. Hence, foreign investors are confused since they believe Indian market is expensive. At the same time, they don't want to miss the growth. So, this high valuation is the challenge. So, in the next 6 months, stock selection expects to play a key role. Second, China. He said if China devalued their currency against US dollar means that will make the Chinese goods very cheaper, which then will be very challenging for Indian companies to compete their products both domestically as well as in international. Third challenge is straightforward. He expects the slowing down of global growth, which in turn will affect both India's export as well as foreign direct investment. So that's it. These were the things Morgan Stanley's MD discussed in his interview. I will pin his interview video and Crystal household savings report in the comment section. If anyone fancy watching and reading it, please have a go. So that's all in this video. Hope you all got some useful information. Please consider subscribing the channel and liking the video so it will help beat the YouTube algorithm and also motivate me to do more. Please don't make any investment decision based on this, as I'm not a SEBI registered advisor. I'm doing this for me and viewers educational purpose only. Thanks for watching.